Okay, continuing on. FastPass is considering 2 alternative locations in which to conduct its CPA review course. One alternative, there you have the option, is an exclusive hotel. The other is a moderately priced training facility. The hotel's central location easily is accessible to potential students, and the training facility is in a less desirable location. FastPass is gathering the following cost data regarding the 2 locations. Determine which are relevant and if their cost behavior is fixed or variable. Now, this does come into play, as we'll see, that most options that are fixed when we go through some of these is irrelevant, because with a lot of fixed things, it doesn't matter how many people or how many units, those costs remain. And it's not true of everything, so I'll point that out. But as you'll see, a lot of fixed costs are a lot of also irrelevant costs. So let's go through these. The rental fee for the classroom. So we have our 2 options, the nice fancy hotel, the less desirable location training facility. Is it relevant? They have different costs. Absolutely. I'm going to do an R there. That's definitely relevant because, of course, they're different. So we are definitely going to mark that as relevant. And what kind of cost behavior is that? Well, those are fixed. Those are fixed. They are relevant. Okay, so not all the time are they fixed or they irrelevant, but we'll see that in a second. They are relevant because they differ between the 2 options. What about the 20 advertising brochures they're going to have to distribute to each of the students? Well, they're going to have to do that no matter what. So we've got 250 for both options. Is that relevant? No, it's irrelevant. It's irrelevant because they're the same. So we don't even have to consider that. That doesn't matter when it comes to our decision. Now, because we are going to have to pay more for more brochures, more students, more brochures, then this would be a variable situation. So think more students, students goes up, then we're going to have more cost. So that is a variable situation. What about the books per student? Doesn't matter where you have it, you're still spending $100. So is that irrelevant or relevant? It's definitely irrelevant. Doesn't matter. Does not matter about our books because they are going to be fixed no matter what. Oh, I missed one. Let's go back to the prior page. The cost of instruction also, it does not matter. They are the same between our options, and does not matter how many students we have. It will stay the same. So this is really a fixed situation. Stays the same. Same, same, same. Same doesn't matter about the students. It is the same. All right, back to our books. Will we spend more books if we have to get more students? If more students come in, absolutely. That'll be a variable cost. That is our activity level here. We're talking more students. Students go up. We're going to need more books, and so our book cost will go up. That is a variable cost. Refreshments. Are we paying for them per student? Absolutely. So more students, more costs. So that's variable. Does it matter between our 2 options? It does. Look, it's $1 difference. So yeah, that definitely matters. This would be relevant to us. And depreciation on instructional equipment. Okay, so now this is where it comes to play where I was talking about a lot of fixed things tend to be irrelevant. It does not matter how many students we have or where we have it. Of course, it's the same no matter what. But it's also a sunk cost because that has been paid for in the past. So even though it is the same, it's sunk. It doesn't matter. And this is a fixed cost. It's going to be the same. Usually we straight line it, same amount every month, every year. Depreciation will be fixed. And it is irrelevant because it's something that happened in the past. It does not matter. All right. Now let's get into something called a special order decision. Now there's going to be situations where as a business you might take on a special order from a customer and the decision comes to you as far as will we lose profit or are we still getting profit based on how much our customers are willing to pay. So should we take a special order? If it does amount to taking a little bit less than we usually pay, do we accept it or reject it? That's the question we've got to ask. Should we take a special order from a customer, maybe a special logo added to a shirt, or maybe they're asking for a special bicycle to be made, something different that they're asking for, a special order when it's going to sell for an amount less than normal. Should we take a special order when it sells for an amount less than normal. And this is a special order. So we have a new customer reaching out to us and they're asking, can you put our logo on a cup for us? And we are going to pay a little bit different, maybe a little bit less than what you would usually get from a customer. Should we take it? Should we do that? If it was more than what we usually charge our customers, then yeah, of course we would take it if it was getting us more income than usual. But in special order decisions, usually it's for an amount that is less than normal. Do we accept or reject it? And we're definitely going to accept it if the relevant revenue is more than the relevant cost. If the relevant revenue is more than the relevant cost, the difference in cost, we're definitely going to choose that. Behavior doesn't impact our relevance. Let's go through here and look at some decisions. Davis Driveways pours concrete driveways for single-family homes. DDI, the Davis Driveways, uses a cost-plus pricing approach. Maybe you've heard of that before. That just means you take all of the costs that is incurred to produce something and you add a little bit extra of profit. Usually it's a percentage, like 10%, or maybe just $10, but you gather up all the costs, you sum them all up, and then you add a little bit of profit on top. The company's accountant prepared the following report, and they established the price per driveway to be $350, and that's what they're willing to charge their customers. We have materials, labor, overhead, and they've broken down for us that their annual overhead cost includes rent on the corporate office, supervisory salaries. There's a normal volume of 1,000 driveways per year, and so the overhead cost has been determined by taking all of the rent and salaries divided by those units. They came up with a per unit amount, but this $80,000 is a fixed amount. That's not going to change. It's not dependent on the number of units. The relevant range usually is 800 to 1,500, which means that is a look from the lowest point to the largest point in units relevant in the short run, and that will not change. A new builder in town, Rachel Rogers, has acquired a large tract of land upon which she intends to build 200 single-family homes. Miss Rogers offers to purchase all 200 driveways from our company, the DDI. However, she's only willing to pay $250 per driveway. Usually, they charge $350. Should they accept or reject the offer? Now, I want to point out, first of all, this is a new builder. This is not somebody that they usually sell to. So business is not being taken away and diverted into a new situation. This is a new customer coming to them. Also, what they usually charge customers is $350. That's the usual price. But now she's saying, I'm only going to pay $250, which is the special order. Should they take the special order? Well, let's go back up here and figure out what's relevant and irrelevant in this decision. I think it might actually be easier if we think about it in terms of what can be avoided and what cannot be avoided. So let's come back up here to our materials. If DDI says, no, we're not going to sell it to you, Ms. Rogers, are they going to avoid having to pay for materials for those 200 driveways? Yeah, they're not going to have to pay for those materials. Are they going to avoid paying the labor, $120 per the driveway? Yeah, they don't have to pay for it. They can avoid it by not choosing to make these driveways. What about the overhead? Now, I understand they put it in a per unit amount, but that's based on $80,000 fixed cost. Are they going to be able to avoid $80,000 if they don't take her order of 200? No. This $80,000 is not avoidable. $80,000 in overhead cannot be avoided. It cannot be avoided. They are going to incur it either way. And this, again, it's a fix. Sometimes you can lean on that, sometimes you can't. But that $80,000 cannot be avoided. But the $100,000 for materials and the $120,000 for labor can be avoided. They would not incur that amount if they choose not to make those 200 homes. The $100 materials, the $120 in labor can be avoided for 200 homes if they don't take the order. Okay, so what does that mean to us? Should they accept or reject the offer? Let's come back up here. She's willing to pay $250. That is our relevant revenue. This could be called the differential revenue. This is different. We'll get $250 if we take on another driveway. Well, if we take on the driveway cost of those 200 new driveways, then we're going to be incurring an additional cost of $220. We're not taking on more overhead. That does not change. We can come back to the profit later. But will they be making a differential revenue? Yes, they'll be taking on $250. Will they be taking on some avoidable cost? Yes, they'll be taking on $220 in avoidable costs. So what does that mean to them? $250 driveway, and they will be taking on the sum of our avoidable cost, $220, which means they will be getting $30 in differential profit per driveway. At $30 per driveway and taking in 200 of these driveways, they'll be making $6,000 more total profit. Even if we're not adding the profit on, a desired extra profit, and we're just taking the $30 at 200 driveways, they'll be making $6,000 an increase to their profit. Again, because our overhead is not avoidable. So that's going to remain. $80,000 will not change. It's important to remember that we want to make sure that our differential revenue, the amount of money that we're getting, is more than those costs that we're incurring. So if that's greater, if our relevant revenue is more than our relevant cost, then we will accept this project. This is solely based on a quantitative reasoning, though. We're not talking about things like capacity. We're not talking about do we have even the capabilities, the labor, the workforce. There's a lot of other things to consider. But when it comes to numerical quantitative analysis, then yes, we would accept it because the cost to us would just be an additional $220 per driveway, and the driveways would bring in $250 in revenue. So here's some more practice. Take a look at this one. I'm going to pause it, and then I'm going to come back and work it. So if you just give yourself a second and pause this one, to read through it, and I'll come back and walk through it. Okay, I hope you had time to look through that. First question was, what is their current profit or net income? We're kind of using those interchangeably in managerial accounting. So I first looked at those machines that they're producing. They've got 7,000 machines here, and I broke it down into direct labor, $15 per machine, direct materials, $40 per machine, and then we've got those fixed costs. And again, you can't rely on this, that it's going to be something that is not avoidable. But typically when we talk about things at the product level or the facility level, then it doesn't matter how many more we make, those costs will remain the same. So at the current level here, the revenue, we've got $2,000 of our profit at the bottom line, the revenue less all those expenses. Now what would be the change in profit if they accepted this special order? Take a look at that one real quick and I'll walk through it too. So going back up here to the top, we are going to be looking if the relevant revenue is more than the relevant cost with these special order decisions. So coming back over here, what is our relevant revenue if they took on those 2,000 extra machines? And I forgot to note this before about the whole relevant range, but they do have to have the capacity to do that. So they have capacity at 10,000, currently at 7. So yeah, they can definitely take 2,000 more. So what's our relevant revenue? Well, they're going to be selling these new ones, the special order, at $60 each. So that is our relevant revenue. What is our relevant cost? And I'll remind you again, relevant costs are things that can be avoided. Can we avoid the product cost? No, because it's fixed. It doesn't matter how many we make. Can we avoid the facility costs? No, those are things that we cannot avoid. It does not matter if we take on more or less. They will not change. So what is relevant cost? The only relevant cost here are their costs per each unit. So here we have, what are the relevant costs? 15 plus 40, $55 in costs. Does our relevant cost, the new cost, exceed or is more than the relevant cost? Yes, it is. We have a $60 $60